How concerned should we be about a potential growth rate not much more than 1%?
Yes, well, this does underpin our forecast, and it does reflect us doing more work, having seen some of the revised New Zealand statistics data on slower than expected growth rates over the last part of last year, to say, well, how much spare capacity is there in this economy, given we've been through such a long recession, and during that time there's been very repressed investment in new plant and capital, and that does take a toll on lower productivity. And you can see we've got lower numbers in there. Now, these are numbers that aren't observable for some time. They are quite important in our forecasts. You've always got to say there's some risk around those numbers. It could be that we've got a higher potential than that, but we're taking a fairly cautious approach to that. This is a phenomenon that a number of different countries in the OECD are seeing and going through after the global financial crisis. We've been scarred by that crisis and by lower investment through it. It will take some time to build up the productive capacity of New Zealand to get potential growth back onto the pre-GFC track.
Governor, you talk about this investment drought in here as households and companies are unwilling to invest much. How are we going to break that investment drought if households and corporates remain so tight?
Well, we do have a view that households remain quite cautious, and then broadly they're interested in deleveraging, and they're not taking on debt under the conditions they were previously, and that does come through in terms of slower consumption, slower growth track. But we do think, as we've said, that we're seeing some recovery on the residential investment side, some more building activity. The proof of that is really going to be in a quarter or maybe 6 months' time, when we see how Christchurch goes and when we see how much that demographic demand for extra housing is being met in other parts of New Zealand. And it could be that there's quite a lot more activity at that stage. Our role, we think, is to ensure that we have price stability and broader stability across the economy, so people can go on, make up their minds about their own consumption and their own investment in a sensible way, and help do that for New Zealand's growth, rather than seeing a sort of consumption-fed bubble of the sort that we at times had during the 2000s.
Do those supply constraints in things like housing and skills, could they restrain you from responding with monetary policy if the European crisis worsens dramatically? Cutting rates.
Well, we're of course going to look at domestic factors and international factors, and indeed this forecast is one where we've got international risks and potential for a bit more domestic strength. That's always going to be the balance that we're going through. The European side is a significant risk, one that we're watching closely but haven't factored into our core forecasts here. If you were to see a real European or Eurozone meltdown, of course that's going to be reflected through in our forecasts. The channel for that will be through our exports, other country exports, commodity prices, and potentially changing conditions in the funding markets for banks in New Zealand. So absolutely that'll be a core issue that we would be thinking about in terms of monetary policy. If you had a booming building sector at the same time, you've just got to balance that out.